All right. Well, hello, everybody, and welcome to Replace Your Income with Kevin and
Steve. How's it going, Kev?
It's so good. It is so good. Why do you think I'm laughing, Steve?
Well, I don't know. It just seems like forever since I've even talked to you. Maybe that's what it is. Or maybe we talk every day. We just haven't been in this room talking to each other.
Yes, that is probably what in fact, we've never really been in this room talking to each other.
Ever.
Not like this. Because we just moved offices and we, for the first time ever, we're doing a couple things for the first time ever. One of them is we are recording in our brand new podcast studio. We should give it a name. What should we name it?
Oh, man. You're putting me on the spot.
We're going to name it Becky. Our brand new podcast studio named Becky. We are in our brand new podcast studio and we are in our brand new office because we just bought an office. We just moved the entire company over to this amazing new office. That's two. So first, number one, we're in our new studio. First, number two, it's the first podcast in the new office. And first, number three, I'm going to point at the camera because we are video recording these podcasts from here on out because we hired somebody who's really amazing. And I'm going to shout him out because not only is he amazing at what he does, but he's also my nephew, Justin. Justin, just say, hey, so everybody hears you on the mic.
Hey, I'm on the mic.
And Justin is here to make sure that we can video record these podcasts so that we can put the podcast on YouTube, we can put it on all the channels that we've been on before, and we can engage this content or help you all engage this content more than ever before. So we are super pumped. So we have all of these first, Steve, and all of these first, and you didn't even do your hair today. Is that what you said before?
Yeah, I just got up and ran over. You called me. You're like, we're on the air in like 5 minutes. And so I raced over. Here I am. We're ready to go. But it's been fun. Unfortunately, we haven't been doing the podcast like we have been. I'm super excited to get back doing them. But it's been a journey putting together the build out of this space. It's been a lot of fun. This is a really neat room. So I'm excited to get rolling again. I've had so many people like call me or text me or email. It's like, hey, did you guys like disappear or like what happened?
My favorite is that people have asked me like, so when does season 2 come out? I'm like, oh yeah, totally. Yeah, this is season 2. Yeah, we're just waiting for the re-release. No, we've just been busy. But honestly, we are. I think, Steve, you would probably agree with me that there's been an aspect of procrastination because we've been waiting to be in this space. We've been like, well, we could keep recording in Kevin's office, or we could wait to start to do the real podcast in our real studio. And it's really cool. Like, if you guys ever come and visit us here at the office, and we invite you to, you got to come take a look at the studio. We have like acoustic panels on one side. We have like acoustic fabric and foam on one side. We have like this, is it? Barnwood.
Actual barnwood.
It's actual barnwood from Steve's barn. Actually, it's Steve's.
Well, actually, it's from a barn somewhere that, we don't even, like some settler.
Really?
Yeah. Oh, yeah. Like it's legit.
Okay. It's maybe worth something.
1847.
Yes. Let's say that this barnwood is at least 200 years old. We have at least 200-year-old barnwood on the wall. And then right behind me, we've got this brick wall. And so if you're watching on camera, this is kind of the acoustic panels. And you'll see we wanted to do this because if we're going to be doing more and more video content, we're like, how can we spice it up so that people aren't just seeing the same thing every time? And so we just thought it'd be kind of cool to do a studio like this. And so anyway, but this is super awesome. We're so excited to be here. We're excited to have Justin on board so we can do this thing right and get it on YouTube and get it on all the podcasting platforms. But Steve, what we're really here to talk about, because it's the Replace Your Income podcast, is we should probably talk a little bit about real estate.
Great idea.
So I gotta also mention this. We have also been hard at work on the book. It is getting really, really close, you guys. Oh my goodness, I can't wait.
Well, it's done. We're just like doing all the stuff after you're done writing the book.
We're waiting to like lock the manuscript, but it goes back and forth with editor. But it is so I just want everybody listening to know. We wrote and rewrote this thing, I don't know how many times, and not because the content wasn't amazing from the jump. It was because we were so intent on creating content that would speak to you And whoever you are, whether you're hearing us for the first time or joining us on YouTube for the first time, or whether you've been along the entire time in this whole ride, we wanted to make sure that we didn't just put a book out, but we put something out that would stand the test of time, that our grandkids could be thankful to read, that would be even evergreen for them, that was principle-based. And so we've been through this amazing journey, and we're really proud of what we've put together.
Well, when you speak about grandkids, like I have 4 grandsons, and they were really, really young when we started writing the book, and they're getting older now. Like some of them 3 of them can actually read now, Kev. So it's time to like get this book out there.
Yes.
And we literally can get my grandsons reading.
I can't wait till I learn to read. That's going to be cool.
Yeah.
Can they teach me? That'd
Yes.
be really nice.
Yes.
So, well, let's jump into some of the real estate stuff, because we're in kind of this crazy, if we just dive into the real content of the episode, we're in kind of this crazy world right now, right? So as we are recording this, we're in June of 2023, and there's been a lot of stuff that's been going on in the market, right? It is a drastically different market from when we started the podcast, from when we started the book. And what's been cool is, Steve, this is just another one of the market cycles, another one of the iterations of the real estate market. And I mean, how many times have you and I sat on these microphones and said, when is the right time to buy real estate? It's always, well, it's yesterday. But if not yesterday, then now, right? Or 20 years ago, right? Or now. It's always now. And what's so crazy about that is we can literally sit here and say, we should have been buying, and we're buying, and you should have been buying during the Great Recession. And then you should have been buying afterwards. And then you should have been buying during COVID. And now you should be buying today. There's never a time you shouldn't be buying, even given the current market scenario where people are like, oh, but interest rates are super high, and I don't really know what's going on in the market, and is there going to be a crash, and the government's dealing with debt ceiling, and we've got Russia and Ukraine. I mean, there's all of this stuff, but the answer, Steve, again, if you are listening, if you're watching on YouTube, when should you be buying real estate, Steve? What should we tell them?
Yeah, I mean, it's such a great question. And it's interesting because over the 15 years that we've been doing this, it seems like every 5 years when we're talking to somebody, in fact, we are having a conversation with somebody 2 days ago. You remember what he said to us? It's like, where were you in my life 5 years ago?
Yeah, that's right.
And it was like, well, we weren't in your life 5 years ago, but we are today.
Yeah.
And so today is the next best opportunity. And his concern was, well, what about interest rates? And what about the fact that prices just went up significantly? And, are there a bunch of pending, foreclosures? Is that going to drive prices down and so on? And the reality is this is my opinion, Kev, is that of any time in the history since I've been buying real estate, which is going on 20 plus years now, investing in real estate on a fairly regular basis, I've never seen a better opportunity to buy real estate than today. Now, the argument could be made, well, what about when you bought homes at, less than 4%? Well, that was a pretty cool time. But guess what? On every one of the properties that I bought, I paid above asking price, anywhere from $10,000 to $20,000. They were still great deals. They're still great opportunities. And because of the interest rates, I had pretty decent cash flow. But the reality is I was buying when appreciation was really high as well, just a few years ago.
Sure.
But prior to 2008, literally at the peak of the market, I bought several properties. And then, the market did its thing and it crashed big time.
Yeah, it did.
and so it was like, hey, I'll collect my $200, $300, $400 a month cash flow. I'll just hang on. And at the end of the day, within about 6 years, like those became the best investments in anything that I had ever purchased before. And the reason why I think that today is an even better time than having bought like in 2011 when the market was really low, when it was like almost cut in half, is that right now, and why it's even better than when I was buying 3 years ago, during COVID when interest rates were below 4% and appreciation was going through the roof and that whole thing, is that here's the reality, is that there is still a massive shortage of affordable homes, the types of homes that we buy, the 3-bed, 2-bath, 2-car garage homes in middle-income neighborhoods in the right markets. There's never been a better time, because right now, like it's like the market is kind of normal in terms of when I make an offer. It's like I'm like the only offer. Like
Yeah.
the blood, the water isn't red with the blood of all of the sharks in the middle
Right.
with a feeding frenzy.
Yeah.
So I'm actually getting the deals a little bit below. Somebody's asking $305,000. I offer them like $295, and I get it for $297.
Yeah.
Right. So I get a bit of a discount. In fact, I got a really big discount on a property that a partner and I closed on in Dallas.
Nice.
We got it. It appraised for $25,000 higher than I got it. And on top of that, I was able to negotiate them to pay some closing costs, $12,000 in closing costs because of some repairs that needed to be done. And this is a fantastic property. It meets our model like perfectly. And so that's reason number one. Reason number two is people are like, well, what about the cash flow? Because, I'm at 7% interest, 7.25% interest. Well, first and foremost, I bought my interest rate down to 6 and 3/4, I believe. So,
you weren't at 7%. You were below 7%.
I was below 7% because I bought it down.
Yeah,
and it cost me like
it cost me
like $750. My break-even point was like, I don't know, 12 months or 13 months or something like that, with the increase in cash flow. But here's the deal. In the markets where we're buying, homes are actually still appreciating. And we're putting them at kind of historical norms, even though they're actually appreciating more. This is what we put on our property analysis, about 3%. So this $300,000 home is going to appreciate $9,000 a year. Now, let's say that like right now, like the interest rate is 6 and 3/4. But let's say interest rates go down to like 5. And that's when everybody's going to get all excited again.
Right.
And I'm going to talk about supply and demand in just a minute, and what I think is going to happen. But let's say in 3 years, interest rates go down. I'm going to make maybe $250 a month in cash flow more than I am right now. So let's say over 3 years at $200, it's $2,400 a year for 3 years. Let's round it up, $7,500. Well, in 3 years, my expectation is that property is going to grow by $9,000 per year, like minimum in the appreciation.
Just based on purchase price and 3% appreciation.
Exactly. And keeping it like simple. I'm not I'm not even compounding.
No. We're just saying.
So that's $27,000.
If at a minimum, it grows $27,000.
So $27,000. So at the end of the day, $20,000 versus $7,500.
Yeah.
Right. The difference. I'm $20,000 ahead. And here's the thing. If I wait for that lower interest rate and in 3 years I buy, well, now I'm paying $327,000 for that property.
Yep.
Minimum, right? And so it makes way more sense from that cost benefit analysis. Like simply said, like today was a good time to buy, even though interest rates were a little bit higher. The other thing that to consider is that at that point in time in 3 years, like the competition will be higher if interest rates
if interest rates go down, everybody's jumping
Now we
back
never
in,
know what
right.
interest rates are going to do, but I do a lot of reading and so on, and all the experts again.
Still hoping to learn to read. You have to tell me what that's like. I'm really
They're
interested.
saying that interest rates could be in the 5s. That's what they are expecting as things get under control, better under control. And so, well, guess what's going to happen then? There is massive pent-up demand. We are still millions of homes short of what this country needs for these types of affordable homes.
Yep.
And so in that moment, there's going to be a lot more buyers, a lot more competition, and that $327,000 purchase price might bump up to $330,000, maybe $345,000 or $335,000, maybe even $340,000.
Sure, once
because
everybody
of
jumps in
multiple,
and demand,
multiple offers, that kind of a thing. And so at the end of the day, if that's the case, then really the home that I bought today is worth $40,000 more, not $27,000 more. And so and you can always refinance, right? So in 3 years, if I refinance, I can always refinance it down and get that lower rate. But I can't like refinance the purchase price down, right?
Yeah.
And so I'm pretty excited about, what we're experiencing with our current clients who are buying. It's really fun to have a normalized market where we go out, we make an offer, we get it, we're not competing against.
Wait a sec. I just want to, can we just pause for a second? Because you said a word that I think very few people are hearing or experiencing right now, and they don't understand that is what is currently happening. You said we are experiencing a what kind of market? Do you remember what you said? Started with an N and it ended with Ormal.
Normalized?
Yeah, normalized market. So hold on. Just hold the phone for a second. You need to shift your brain function right now, okay? So you have been likely operating under the assumption that it's a bad market, or that it's an up market, or it's a down market, or it's a whatever fill in the blank market. Dude, it's a normal market. Now, what does that mean to us? You just started to describe it, so I'm going to have you jump back into it, but I just wanted to pause and help everybody realize, there's so many times that we hear this constant barrage of little birdies, in our ears, that we like to call them the teeny tiny pockets brigade, which is those groups, those people in your life that are not investing in real estate, that are not doing a ton of investing in real estate, that are not researching real estate.
We're living in fear all day, every day about everything.
Living in so much fear. And they are the ones that are informing. They're the ones that are writing the scripts that are going into the teleprompters that the news people who don't even have the actual knowledge base that they're claiming to have, that they're the ones that are reading from the teleprompter, telling you what you should be feeling about your life and about your real estate and about your money and about the market and about the government, but they are the teeny tiny pockets brigade. Do any one of them have 10 properties that they're actively managing or looking at? Do any one of them actually invest in real estate outside of handing a bunch of money over to one of their Wall Street hedge fund buddies and say, go make me a bunch of crap because you're going to use insider trading? If they're not actually using the kinds of mentality and methodologies that we're using, that you're using as a real estate investor, and they're going to sit there and tell you what you should be thinking about the market, when in reality, that's what's informing our fear. That's why we're saying it's a bad market, it's a good market, it's an up market, it's a down market. It is not based in reality. The reality is the market has normalized. And so, Steve, let's talk about what is a normal market and why is this market a normalized market?
So historically, appreciation is right around 3%. Well, in many of the markets across the country, I would even venture to guess the majority of markets across the country, they're experiencing around 3% appreciation. There are some markets where it's been negative over the last few years, where they had such incredible appreciation during COVID that they are normalizing, right? They're coming back to where prices ought to be, where they should be. And so even those markets are normalizing. But in the markets where we're at, they saw good appreciation, but not like the craziness that we saw in some of the other markets. And so they've come back to normal, about 3%. Guess what historical averages for mortgages are? Like around 7%.
Yeah, I remember that's when I got into mortgages. That's what they were. Then for years until the recession, that's what they were. I honestly don't remember what interest rates were during the Great Recession. What were they during? Were they like 5s and 6s? I don't remember what they were. Like when we were buying in Arizona and Vegas, like I'm trying to think of what interest rates were during that time.
Yeah, they're 5.5 to 6.5-ish, right around there.
And then the interest rates tank, right? They're really low, and it's so funny. It's like, we kind of are like, what is it that you boil? Is it lobsters that you boil and you like just slowly turn up the temperature? Frogs. And so, but what happened to us is the temperature of interest rates got turned down so quickly, so drastically. We acclimated as a whole American society to believe that was the norm. We're like, well, however could I ever get another mortgage again if it is not at 2.75%? Listen, that train passed you by. It's not coming back. Don't expect it to come back. So go ahead and sit on the sideline and keep just waiting for 2.75 to come back. It ain't coming back, right? Normal interest rates are what we're facing. And what we're talking about when we're looking at like high 6s, low 7s, that's on a 25% down investment property, right? If you look at interest rates on primary residences, they are right around that normal level they've been at for a long time, maybe slightly higher, because we're trying to tamp down inflation, because we've had this insane inflationary monetary spend policy. We just went through this whole this debt ceiling negotiation, which is like, well, there's no way we can pay our bills unless we go into more debt to pay the bills, to go into more debt, to have to talk about this again. Like, we're in this insane economic climate. So if you think that in that insane economic climate, you're ever going to see 2% interest again, forget about it. Inflation has been running rampant. We've got to tamp it down. Recessions are around the corner. So the reality is Interest rates are not even as high as they should be. If we actually wanted to get this thing under control, they would be a lot higher, but we don't. And so the reality is interest rates are going to be right where they are, or a little bit lower or a little bit higher, but we're in a normal market just from an interest rate standpoint. And in addition to the interest rate standpoint, Steve, just talk briefly about like listings and sales and how long properties are sitting on the market and what the negotiation looks like as we're buying properties, because that's back to normal too.
Yeah, it's much more normal, right? As normal as it's been in a long, long time. And what I would say also to the interest rate really quickly, for those of you who are living in like crazy fear that interest rates might even still be going up, because maybe they will. Maybe 7%, maybe 7.25%, maybe that's low for where interest rates are going to go. And buying today, you might be actually buying at a low interest rate.
Yeah.
So from that perspective, right? But over time, the expectation is for things to come down and to continue to be fairly normal. But the reality is if interest rates fall a little bit, there's not going to be the kind of demand that we saw during COVID. I don't think we're going to reach those levels again, because the interest rates are not going to go back down to the twos, the threes and the twos. But if they do get into the fives again, people are going to jump. I don't even know what the generation is called. Generation X, Y,
totally
Z, whatever it is.
Yeah.
But I was just reading another article talking about this demographic. They're a little bit older than in the past when they purchased their first homes. But that demographic is reaching the point where they are beginning to purchase homes. They're at a point in their careers. They're at a point in their lives. This generation, they got married a little bit older, having kids a little bit later, getting their careers, set up and getting established and so on. It's
probably like the older half of the millennials, I think, right?
It may be.
Yeah.
It may be. I'll have to find that article and refer to it. But they are in the process. There is massive pent-up demand just with this group of individuals. And so because of this shortage, and the builders know it, but they're being very cautious. They're being very careful. They don't want to get stuck and sitting on a bunch of inventory. They learn from the past. And so it's more kind of like, hey, as the demand goes up, they'll start building again. And it's kind of this cycle. It's kind of how our economy is evolving. And so those are some of the reasons, Kev, why I feel like right now is as good of an opportunity as ever before. And what I can promise you and anybody listening to us today is that 5 years from now, if you didn't get in the game today, you're going to potentially remember this podcast and be like, yeah, these guys are trying to tell me I should have gotten the game 5 years ago.
Yep.
And I can all but promise you that will still be the case 5 years from now.
Yes. And I just want to remind everybody of the principle of opportunity cost, because that's what you're talking about. Like if we run it back to the beginning of the podcast when we were talking about okay, so interest rates higher than maybe you'd like them to be, fine. Maybe your cash flows are lower than you'd like them to be, okay, fine. But, and we've talked about this on the podcast before, there's just a lot of people that are trying to time the market and think that they know better, but here's the reality. The reality is, okay, fine. Let's say you got $100 a month in cash flow. Maybe it's $50 a month in cash flow. And you're going, well, there's no way I'd invest in real estate right now with only $100 a month in cash flow. And now that we have a camera, you can see the motion of my shoulders and I'm shrugging. But like normally you would just hear my voice. But the CA video. If I'm going, all right, I only have $50, $100 a month, and I don't want to invest, fine. You know what? Stay out of the market. Let us go gobble up everything else, right? No, for this reason. Because if you want to stay out of the market because you're worried about a little $50 or $100 cash flow, that's fine. Somebody else, and here's the key, understand this. Somebody else will come in and gobble up that $10,000 a year of appreciation. You don't get that.
Well, and on top
you
of
are
that,
trading that $10,000, that $9,000 we're not even talking about, tax savings or principal pay down. You are trading thousands of dollars because I don't know if $100 in cash flow is good enough for me. So that's fine.
And that's the key.
We'll come in and we'll buy it, Steve.
Yeah.
We'll go take the thousands of dollars if they're not good enough for you. I'm serious though, right?
Oh, I know. No, what you're saying is absolutely right. And what's, the thing that people get so caught up on cash flow, that of all the benefits that single family property investing brings, typically cash flow is the least among them. So even in a low cash flow market like today, like you just said,
right,
there's still a principal pay down of $300 to $500 a month. That's there regardless of your cash flow. Whether your cash flow is $1,000 a month or whether it's $100 a month or negative, you still have the principal pay down. You still have the depreciation, the tax advantages, and you still, of course, have the appreciation. And I'll throw one more thing in there.
Please do.
If you happen to be a real estate professional, there is a massive opportunity that you're missing out on if you're not investing in real estate, and that is called accelerated depreciation. And that is something that actually is changing on an annual basis. That opportunity came to us, thanks mainly to a prior president who happened to be in the world of real estate. And so, he made some changes that were advantageous to real estate investors called accelerated depreciation.
Are you talking about Thomas Jefferson? Was that who you're...
A little bit after Thomas Jefferson.
Cool,
cool. Just a little
Calvin
bit.
Coolidge. Got it. Okay, continue.
And that's something where literally you can do a cost segregation study and then take advantage of that accelerated depreciation. Last year, I had the opportunity to take advantage on 4 properties that I purchased. And that was about 80% of what it was the year before that. This year, it's going to be about 60%. And so there's a huge opportunity for real estate professionals that they need to understand and know that, hey, there's something here like right now that I can take advantage of.
Just a couple other things before we wrap the episode. So we're talking about, yes, there's benefits beyond even maybe what you guys realize out there. We're talking about that there is and I just want to reiterate this. Opportunity cost, it's called opportunity cost because it is a cost. You are costing yourself actual, tangible, real life dollars by not taking action. It is tangible, okay? There is a real cost to you not doing real estate right now if you're sitting on the sideline. And the other thing I just wanted to mention, because we were talking about kind of the current real estate market, and this came from a podcast I was listening to recently. Generations change the way that they view the world, right? Just their overall mentality. There are more and more people my age and younger. So the people that are buying their first and second homes right now, that kind of age range, there are people that are buying, but there are significantly more that are choosing never to buy. So, with the advent of things like Airbnb and just kind of this Zoom culture and not having to be located in one single physical location for your job, it has totally shifted the overall zeitgeist and the overall just temperature of how people view where they want to be and where they want to live. And I talk to people that have no desire. I was watching this, there's a Netflix series. Do you know the name? Oh gosh, I'm going to butcher it. It's like Ramit Sethi. Do you know that name?
No.
So he has a really popular book called I'll Teach You How to Be Rich, and Netflix did a documentary series with him. So he's very wealthy, and he teaches other people how to get wealthy. And in this Netflix series, like he is talking about, and he's probably, I don't know, maybe my age, maybe a little bit younger, so probably early 40s, late 30s. He is talking about why the massive benefit of your life would be to rent a home and not go buy, right? It's a totally different way of thinking, but it is becoming more and more prevalent. Now, why is that? Why does that matter to this conversation? Because we always say everybody's in real estate. You're either on one side or the other. You're either on the side of real estate that's making somebody else money, or you're on the side of real estate that's making you money. So if your opportunity cost is to remain on the side of the real estate that's making somebody else money, cool. The cost is you're not going to make the money that somebody like you, that people like you and I, Steve, are going to go make, because we are going to go and invest in real estate, right? And so the world is changing. You have to change the way that you're thinking about things, and you have to stop being crippled by fear. And we can honestly look at the camera and look at the microphone and tell you, listen, if fear has been the reason why you have not taken whatever action that you felt like you needed to take, I'm telling you right now, fear is nothing more than false evidence appearing real. When you experience fear, your body releases things like cortisol, and it makes you feel like you shouldn't do something. You're actually believing that you are getting this intuition that you shouldn't be moving forward. But it is your body and your mind and the evidence that is not real evidence, but it appears to be real, that is tricking you and keeping you on the sideline and literally costing you potentially thousands and thousands of dollars. And that's really what we wanted to jump on and say today is like, I promise you, like if you're not taking real, genuine, significant action, if you're not carping your DM, you are missing out. Right? See, anything you want to add before we wrap the episode?
Hey, I'll just wrap up my comments by quoting Warren Buffett.
Oh, who's that? I've never.
He's the most successful investor in the world.
Okay.
Yeah.
Okay. Is he like Tony Stark, kind of?
No, that would be Elon Musk.
Okay, got
That'd be Elon Musk. This is another gentleman that
Okay.
I'll introduce you to.
Yeah,
him.
please. That'd be great.
Yeah. So he basically says, hey, one of the secrets to my success is that I buy when everybody else is selling and I sell when everybody else is buying. And this is one of those moments where that kind of a thing is either happening or there's a version of it, which is buying when everybody else is pressing pause.
Yeah.
And that's more than anything what's kind of going on right now. And I totally understand. I totally get, the fear, the trepidation. And sometimes I think that there's a little bit of, the sense of, I know better, or I know
sure.
best, or my brother-in-law knows best, or
Teeny
something
tiny
like
pocket
that.
brigade. Yeah.
Yeah, those guys. And so it's like, really, take a deeper dive, a deeper look into the opportunity today. As of this year, you and I have purchased multiple properties
yes.
together.
Right.
And it's because we truly believe that this, like, it's as good or better opportunity than we've ever seen before. So those are my final words.
Well, and I think that's important just to kind of, make known to the audience. Like we're not just saying this stuff. Like we are buying and acquiring as much as we can because we actually believe the things that we are saying. And I will just say this: if you have not been to dfy-realestate.com lately, and you have not gone to the See the Properties tab, and you have not gone and actually seen the new property analysis, like I am telling you, if you will look at the actual numbers of what real estate can really do for your reality, there's a lot of reals, you are missing out. There is amazingness around the corner for you if you are listening, and we would love to be able to help you in any way we can. But we're just thankful to be back on the mic, back on the Replace Your Income podcast. We got another episode coming up real soon. And by the way, the next episode, Steve, I'm telling everybody right now, you are going to want to tune in next week. We are going to address a question that we get all the time, which is, even if a property has negative cash flow, should I buy it? Would it make sense? We're going to lay it all out for you and break it all down on the next episode. But for now, this is Kevin Clayson and Steve Earle signing off, and we'll talk to you real soon.
Take care.